Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of how economic trends shape investment strategies in 2025. Economic trends aren't just headlines, they're key drivers shaping how and where money moves. From shifts in interest rates to changes in consumer behavior, these forces ripple through global and local markets, impacting investments in surprising ways. Understanding these patterns helps investors make smarter decisions, minimize risk, and spot new opportunities. Whether you're navigating a volatile market or planning long-term, keeping an eye on the economy is essential to staying ahead. The role of economic indicators in assessing trends. Economic indicators are like the dashboard gauges for a country's economy. They signal where we've been, where we are, and where we might be heading. For investors, these metrics help paint a clearer picture of opportunities, risks, and the best times to act. Let's break down some of the most important indicators and how they influence investment decisions. GDP growth and its influence on investor confidence. Gross domestic product, GDP, is often called the pulse of the economy. When GDP is growing, it's a sign that businesses are thriving, jobs are being created, and consumer spending is on the rise. This creates a ripple effect, boosting stock market performance and encouraging businesses to expand. For investors, consistent GDP growth fosters confidence. A strong economy can lead to higher corporate earnings, making stocks more appealing. On the flip side, when GDP slows or contracts, it can signal tougher times ahead. This can lead to more cautious investments, as sectors like manufacturing or retail often take the first hits during a downturn. Investors often watch quarterly GDP reports closely. A higher than expected figure can push markets upward, while disappointing numbers can prompt rapid sell-offs. If you're trying to make sense of market volatility, tracking GDP is a great place to start. Inflation rates and purchasing power. Inflation is like the hidden tax on your money. It erodes purchasing power over time. When inflation rates rise, your dollar buys less than it did last year. This has a direct impact on currencies, interest rates, and the way investors plan for the future. High inflation typically forces central banks to raise interest rates, which can cool down stock markets. Why? Borrowing becomes expensive, slowing business growth and consumer spending. Bond markets, on the other hand, might see renewed interest as yields rise with rate hikes. For long-term investors, inflation necessitates strategic planning. Assets like real estate or commodities often perform well in inflationary periods because they tend to hold, or even increase, their value. Keeping inflation in mind can help you safeguard your portfolio and choose investments that outpace rising costs. Unemployment rates and workforce stability. Unemployment doesn't just reflect job loss, it reflects consumer spending power. When more people are employed, they earn wages, spend money, and drive economic growth. But when unemployment rises, spending often declines, straining businesses that depend on consumer demand. Certain sectors feel the effects of unemployment more than others. For instance, consumer discretionary stocks, like retail and travel, often see a hit when unemployment spikes. On the other hand, defensive sectors, like utilities and healthcare, tend to hold steady since their demand is less tied to job stability. For investors, employment data provides hints about the economy's direction. If job numbers are improving, it might signal growth ahead. Weak numbers, though, could indicate that a market downturn is around the corner. Consumer Confidence Index. The Consumer Confidence Index, CCI, measures how optimistic or pessimistic people feel about the economy. Think of it as a reflection of the public's collective mood. When confidence is high, consumers are more likely to spend, take on loans, and invest. Low confidence, however, leads to cautious saving and scaled-back spending. For businesses, consumer confidence offers valuable insights. High confidence can encourage companies to hire, expand, or launch new products. As an investor, understanding these trends can help you anticipate which industries might thrive during optimistic periods, and which might struggle when sentiment dips. The CCI is also a tool for predicting shifts in market behavior. A decline in confidence can signal weaker retail sales, affecting sectors tied to discretionary spending. Meanwhile, a rise in the index could boost sectors like housing and automotive, as consumers feel more secure about making big purchases. Each of these indicators tells a part of the economic story, helping investors assess the landscape and make informed decisions. Globalization and its economic impacts on investing. Globalization has made the world more interconnected than ever. Goods, services, and ideas now flow across borders with unprecedented speed, creating both opportunities and challenges for investors. While this connectivity opens up access to diverse markets, it also brings exposure to economic shifts, political tensions, and currency risks. Below, we'll explore the key ways globalization shapes economic trends and impacts investing. Emerging markets as growth drivers. Emerging markets have become key players in the global economy, driven by thriving populations, rapid urbanization, and rising consumer spending. Countries like India, Brazil, and Indonesia are posting GDP growth rates that outpace developed economies, and this momentum attracts investors seeking higher returns. Why bet on emerging markets? These regions often come with high risk, high reward potential. They're rich in untapped industries like technology, manufacturing, and renewable energy. For example, as middle-class populations grow, sectors like e-commerce and healthcare boom. Investing in emerging market funds or ETFs offers exposure to these opportunities while spreading risk across multiple countries. However, navigating these markets requires caution. Political instability or currency fluctuations can quickly erode returns. Diversifying across regions, using hedging strategies, or sticking with strong sectors can help mitigate risks. Smart investors focus on areas with solid infrastructure growth and favorable government policies to maximize opportunities while managing uncertainties. Impact of trade policies and international relations. Trade policies and international relations can be the silent hand steering capital flows. Tariffs, free trade agreements, and cross-border regulations directly affect the profitability of exports and imports, creating ripple effects throughout the investment world. Take tariffs, for example. A country imposing high tariffs on imports might protect local industries but hurt global manufacturers dependent on cross-border supply chains. Investors in affected sectors, like automotive or technology, often see profit margins shrink, forcing them to reassess their strategies. Similarly, geopolitical tensions, such as trade wars, create volatility. A thaw in relations can spur market rallies, while sanctions, embargoes, or diplomatic breakdowns can send shockwaves through industries like energy or defense. For investors, staying informed about policy shifts is critical. Monitoring international treaties, trade alliances, and regulatory updates allows you to pivot quickly and avoid potential losses. On the flip side, liberalized trade policies open doors for global companies to expand their markets. This benefits investors in sectors with international exposure such as consumer goods, tech, or agriculture. Deciphering how trade policies tilt the playing field can help you make informed investment moves. Currency exchange fluctuations. Currency exchange rates play a huge role in global investing. A weak or strong currency can significantly influence the bottom line for multinational corporations and impact returns for foreign investors. For example, imagine a U.S. company selling products in Europe. If the euro weakens against the dollar, the company earns less when converting revenue back to dollars, potentially cutting into its profitability. Investors holding shares of that company may see stock prices dip as a result. Conversely, favorable exchange rates can provide a boost to multinational profits, increasing shareholder value. Forex markets also open doors for direct currency investments. Traders and investors can speculate on currency movements through Forex trading, foreign bonds, or currency ETFs. But be warned, currencies are volatile. Exchange rates are shaped by factors like interest rate policies, political stability, and economic data. Staying on top of these drivers is essential for effective decision-making. For long-term investors, mitigating currency risks is just as important. Some opt to hedge currency exposure using financial instruments like futures or options, while others diversify into domestic-focused companies to reduce vulnerability to exchange rate swings. The interplay of globalization and currency dynamics reminds investors to focus not just on profits but also on the external forces shaping them. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.